Good morning, everyone. My name is Jessie Gicana, one of the reporters of Investing in Stocks. So, good investors know something about the company before they invest in a company's stock. They gathered information first to know and evaluate a potential investment in a stocks. Corporations often have two types of stocks, the common and preferred. So these stocks are both disadvantage and advantage to its investors because investors can have a potential return on investment, but at the same time, it gives a higher risk or they can even lose their initial investment. Why do corporations issue common stock? To answer this question, let us first know what is a stock. A stock is an equal financing, which means that it is the ownership of the investors in a corporation. When you own a stock, you are entitled to be called a shareholder or even stockholder because you have the right and you share in company's profit. To avoid confusion, shareholders is also referred as stockholders because it owns at least one share of company stock, which is known as equity. So, in this question, or back to the question, why the corporation issue common stock? Simply because they help to raise money to start and expand business. The money that the investors invest will be used to raise money by means of development of new products, investment new equipments, increase inventory, and many more. So, corporation may issue stock by selling a percentage of profit in the company. Second, pay ongoing business expenses. Third, not to repay the money. So, they don't have to repay the money. It's because the stockholders or the shareholders pays for the stock. Fourth, dividends not mandatory. Dividends are not mandatory because some of corporations distribute 30 to 70% of their earnings on stockholders. In return for investors in investing in a company, they have the right to vote or elect for the respective board of directors. And board of directors are the one that is responsible for protecting shareholders' interests, establishing policies for management, oversight of the corporation, even creating dividends policy. Next is why investors purchase in common stock. So, before anything else, what is a common stock? A common stock, it is the most common type of stock that is issued by the company. It entitles shareholders to share in the company's profit through dividends and capital appreciation. So, common stocks are usually given voting rights with the number of votes directly related to the number of shares owned. Of course, the company board of directors can decide whether or not to pay dividends as well as how much is paid. So next is, through investing in common stocks, investors make money in three ways. By income from dividend, dollar appreciation of value stock, and possible increase value from the stock splits. So first, in income by dividends, along with the profit investors can make by selling stocks, and it can also earn shareholders dividends or portion of the company's earning. Cash dividends are usually paid on a quarterly basis, but investors might also earn dividends in the form of additional shares of stock. Next is the dollar appreciation of capital stock. So, capital appreciation mostly arise in an investment's market price. Capital appreciation is the difference between the purchase price and selling price of an investment. If an investor buys a stock for $10 per share and the stock price arises to $12, the investor has earned $2 in capital appreciation. When the investor sells the stock, the $2 earned becomes the capital gain. Next is possible value stock from splits. So, a stock split is a corporation action in which a company divides its existing shares into multiple shares. If you own a stock that declares a split, the number of shares you would own after the split increases. However, the price per share reduces. So, the next is dividend date. So, the first one is declaration date. So, the declaration date is the date on which the board of directors announces and approves the payment of the dividend. So, the declaration includes the size of the dividends being issued and outlines the record date and payment date. Second is the record date. It is the date on which the investors must be on the company's book in order to receive a dividend. Next is the ex-dividend date. It is the first date that a stock trades without a dividend. And lastly, payment date. So, the payment date is the date on which the dividend is paid to shareholders. Dividend payments may be either mailed or electronically transferred to the accounts of shareholders. And lastly is the preferred stock. A preferred stock is generally considered less volatile than common stock, but typically has less potential for profit. Preferred stockholders generally do not have voting rights as common stockholders do, but they have a greater claim to the company's assets. Preferred stock can also be callable, which means that the company can purchase shares back from the shareholders at any time for any reason, although usually at a favorable price. And that's all, and thank you.
Good morning, everyone. My name is Samantha May A. Guarda, reporter for the next topic in Chapter 12, which is evaluating a stock issue. It is important to do research before purchasing an investment, and it is also important to know in which industry a corporation operates because it has a great impact the way they operate, and to know the cause kung bakit ang stock is nagdi-decrease or nag-i-increase in value. Investors should know the type of stocks and characteristic of this type of investment. The type of stocks are 10, which is first, blue chip, a safe investment that generally attracts conservative investors. Next is cyclical, that follows business cycle kahit ang economy is mag-advance or mag-decline. Third is defensive, that's stock is nagre-remain na stable kahit yung economy ay mag-decline. Yung growth is it has a potential of earning profits na mas mataas pa sa average profits ng lahat ng company sa economy. Next is income, which is an investment pay higher than the average ng mga dividends. We also have from large cap to small cap. It is a capitalization that a corporation issued stock. First is yung large cap, which is nag-excess siya in 10 billion. Sa micro cap is 300 million US dollars or less. Mid cap between 2 billion US dollar and 10 billion US dollar. Sa penny is typically sells for less than $1 per share. And in small cap, it is a capitalization between 300 million or 2 billion US dollar. So next is the internet. We all need the internet. In evaluating the stocks, the investors need internet, especially nowadays, corporation have its own website. So in internet, we can gather information. So aside from that, these are the links of professional advisory services that can also help have financial information. So where you can find a stock quote and what does one look like. So we have here different links that you can find a stock quote. We have print sources and online sources. So next is common stock price quotes online dito sa website na finance.yahoo.com. This website provides financial news, data, commentary, including yun nandito nga na stock price quotes. And aside from that, it also offers online tools for personal finance management. Here, the common stock price quotes dito is makikita yung last trade price and annual dividend and earnings per share. Next is evaluate stock advisory services. So aside from internet, you can also have detailed information through printed materials provided by stock advisory services. Most charge a fee. Hindi lahat ng information is, although they give information free, hindi lahat ito is free kasi kapag more detailed na yung information is nag-charge na sila ng fee. So, Standards and Poor Reports, Value Line, Merchant's Handbook of Nasdaq stocks. These are the three most popular and most widely used na stock advisory services na nagpo-provide ng detailed research for financial information and for the stock investors. So, next is corporate news. So, ngayon po kasi is limited na yung mga newspapers na nagkakaroon ng financial coverage. Ini-eliminate na nila or nire-reduce na nila yung pagkakaroon ng pagbibigay ng financial information. So, yung mga natitira na lang ngayon that still have some information about stocks is yung Wall Street Journal and Metropolitan newspaper. So, dito is the federal government requires a corporation na mag-provide ng prospectus list of all necessary information. So, next is stockholders also requires to provide an annual report with detailed information about the data. And here, we also hear the website of Securities and Exchange Commission na pwede din tayo mag-gather ng information dito. Next is business periodicals, which is contains information about the stock investing. So that's all for my report. Thank you for listening.
I am Ramaluchi Lorenzo and I report the learning objective 12.3, the numerical measure that influence investment decision. First is corporate earning. Corporate earning consists of how much money a company or corporate has made during a certain period of time. Corporate earnings are calculated by subtracting the total amount of the company expenses from revenue. When you calculate it, you can determine if the company is growing, increasing in profit, and spending. Next is earning per share or EPS is calculated as a company earning divided by the number of outstanding share of a common stock. The result number serves as an indicator of a company earnings. EPS indicates how much money a company makes for each share of its stock, and it's widely used for metric to estimate corporate value. A higher EPS indicates greater value because investors will pay more for a company share if they think the company has a higher profit relative to its share price. Its price-earning ratio or PE ratio relates a company share price to its earning per share, calculated as price per share of the stock divided by the firm's earning per share. A higher PE ratio could mean that the company's stock is overvalued or else that investors are expecting high growth in the future. Companies that have no earnings or that are losing money do not have a PE ratio since there are nothing to put in the denominator. Project earning is an estimated of a EPS or PE result you will see from the business in a future period of time. Is dividend yield. It shows how much a company pays out in the dividend each year related to its stock price. Dividend yield calculated by the annual dividend divided by the current price per share. It's important for investors to keep in mind that the higher dividend yield do not always indicate attractive investment opportunity because the dividend yield of a stock may be evaluated as the result of declining stock price. Total return is the actual rate of return of an investment or a pool of investment over period. Total return is expressed as a percentage of the amount invested. Total return includes interest, capital gain, dividend, and distribution. Book value per share takes the ratio of a firm's common equity divided by its number of shares outstanding. When a stock is undervalued, it will have a higher book value per share in relation to its current stock price in the market. Thank you for listening and God bless you all.
Good day everyone, I am Jinan Malalis. Now we will talk about the learning objectives 12.4, which is all about buying and selling stocks. There are what we call the capital market, where buyers and sellers engage in trade of financial securities like bonds, stocks, etc. The buying and sellings are undertaken by a participant such as individual or institution. The capital market consists of primary market and secondary market. The primary market, stock and securities are created. It is where firms sell new stock or bonds for the first time. Investors are able to purchase securities directly from the issuer in the primary market. Primary markets are facilitated by underwriting groups. It's an association of investment banker or broker-dealers who wish to purchase new securities from an issuer in order to distribute to investors at a profit. One of the primary role of this is to serve as a sort of intermediaries between the corporation and investors through initial public offering or IPO. IPO is one example of the securities issued on the primary market. It occurs when a private company sells shares of stock to a public for the first time, a process known as going public. When a company goes public, the previously owned private share ownership converts to a public ownership, and the existing private shareholder shares become worth the public trading price. Through an IPO, the company is able to raise its capital and the investors are able to invest in a company for the first time. Here's the simple illustration on how the primary market works. Then, there have a secondary market where securities are traded. It is where investors buy and sell securities from other investors rather than with the issuing entity. Secondary market is commonly referred as stock market. The transaction in this market will happen with the help of professional intermediaries like brokers or dealers who trade or buy and sell share in behalf of its clients or investor. Here is the illustration on how secondary market works. Secondary market is divided into two, which are the broker markets and dealer markets. Under broker markets, there are security exchange, where are the buyers purchases the securities directly from the seller through the broker. Dealer markets consist of the over-the-counter market and NASDAQ, where buyers and sellers do not trade securities directly as they do in the broker markets. Security exchange is where securities are traded through a centralized place with no direct contract between the buyer and seller. The core function of an exchange is to ensure fair and orderly trading and the efficient dissemination of price information for any securities trading on that exchange. The New York Stock Exchange or NYSE is one example of it. It is the world's largest stock exchange. It provides a marketplace for buying and selling millions of corporate stock and other securities per day. It is considered as an auction market which uses specialists that are now called designated market maker. The New York Stock Exchange uses two methods of trading, brokers and all electronic. Most of the transactions in NYSE occur electronically. A computer acts as a dealer, matching up buyers and sellers. Even the brokers and dealers get their information and trade electronically. Next is the over-the-counter market. It is where securities are traded by market participants in a decentralized place in which market participants trade stocks, commodities, currencies, and other instruments directly between two parties and without a central exchange or broker. Over-the-counter markets do not have physical location. Instead, trading is conducted electronically. It does not have a file with the Security and Exchange Commission. Therefore, investing in OTC market is highly risky and recommended for those experienced investors only. Another one is the National Association of Securities Dealer Automated Quotation System, commonly referred to as a NASDAQ. It is the largest dealer market and the first electronic-based stock market. The NASDAQ is a sophisticated telecommunication network that links dealers throughout the United States. Many of the world's technology giants, including Apple and Facebook, are listed on the NASDAQ. At the NASDAQ, market makers maintain inventories of stock to buy and sell from their own accounts in transaction with individual customers and other dealers. In order to make right decision in buying and selling securities like stock, you should have acquired some services from brokerage firms. Those are financial institutions that help you buy and sell securities. They act as the middleman between the buyer and the seller. In brokerage firm, they have what they call account executive or the stockbroker. A stockbroker is a professional trader who buy and sell shares on behalf of clients. The stockbroker may also be known as a registered representative or an investment advisor. But ensure that your specialist or broker is reliable and honest to all your transactions because they have what we call churning. It refers to a practice of a broker conducting excessive trading in client's account mainly to generate commissions. churning is illegal and unethical and carries severe fine and sanctions by the Security and Exchange Commission and other regulatory bodies. One way for investors to protect themselves from overtrading is through a RAF account. This account is an investment portfolio that is professionally managed by a brokerage firm for a flat fee that is charged quarterly or annually. That's all po. Thank you.
Discount versus full-service brokers. A full-service broker is a licensed financial broker-dealer firm that provides a large variety of service to its clients. Full-service brokerages are much higher than those at discount brokers. While the discount broker is a stockbroker who carries out buy and sell orders at reduced commission rates, compared to full-service brokers. However, a discount broker does not provide investment advice or perform analysis on a client's behalf, unlike a full-service broker. In computerized transactions, there are 4 reasons to justify the trading online. Number 1 is size of investment portfolio. Number 2 is the ability and desire to manage own portfolio. Number 3 is the ability to monitor investment closely. And number 4 is the capability of computer and software. In stock transaction orders, there are 3 types of stock trade orders. First is the market order. A market order is to buy or sell stock at the current price market value. Also, the market order is an instruction by an investor to a broker to buy or sell stock, shares, bonds, or other assets at the best available price in the current financial market. Second one is the limit order. It is in order to buy or sell a stock at a specified price. A limit order is a type of order to purchase or sell a security at a specified price. This stipulation allows traders to better control the prices they trade. The last and third one is the stop-loss order. Order to sell a stock at the next available opportunity after its market price reaches a specified amount. A stop-loss order is an order placed with a broker to buy or sell a specified stock once the stock reaches a certain price. It also helps the investor to limit the loss on a securities position. Thank you, and that is my reporting.
I am Anjanette Molon and I will be presenting the long-term investment strategy. Once you purchase stock, the investment may be classified as either long-term or short-term. The first long-term investment strategy is the buy and hold strategy. It is also called position trading. It is an investment strategy whereby an investor buys financial asset or non-financial assets such as real estate to hold them for a long time with the goal of realizing price appreciation despite volatility. This approach implies confidence that the value of the investments will be higher in the future. In short, all you have to do is buy a security and not sell it. The second strategy is the dollar cost averaging. It is a simple technique that entails investing a fixed amount of money in the same fund or stock at regular intervals over a long period of time. This strategy is simple. Invest the same amount of money in the same stock or mutual fund at regular intervals like monthly and ignore the fluctuations in the price of your investment. Whether it's up or down, you're putting the same amount of money into it. This can even be done automatically by reinvesting a stock dividends payment back in the stock itself. In the long run, this is a highly strategic way to invest. As you buy more shares when the cost is low, you reduce your average cost per share over time. Dollar cost averaging is particularly attractive to new investors just starting out. It's a way to slowly but surely build wealth even if you're starting with a small stake. And lastly, the direct investment strategy. It is a plan allows you to purchase stock directly from a corporation without having a use of account executive or brokerage firm. Similarly, a dividend reinvestment plan, often called DRIP, allows you the option to reinvest your cash dividends to purchase stock of the corporation. For stockholders, the chief advantage of both types of plan is that these plans enable them to purchase stock without paying a commission charge to a brokerage firm. The fees, minimum investment amounts, rules, and features for both direct investment and dividend reinvestment vary from one corporation to the next. Also, the direct investment and dividend reinvestment funds, you can take advantage of dollar cost averaging. Discussed in the previous section for corporation, the chief advantage of the both types of plan is that they provide an additional source of capital. As added bonus, they are providing a service to their stockholders.
Going to report short-term investment strategies. In this topic, we will know what is the buying stock on margin, selling short, and trading in options. In this investment strategy, it is very risky, and do not use this method when you don't truly understand its risk, lalo na kung hindi ka pa nakapag-try sa traditional method, which is the long-term technique. Pero in this investment strategy, we all know that the higher the risk, the higher the return. Now let us know what is buying on margin. When buying stock on margin, you borrow part of the money needed to buy a particular stock from the broker. For example, you have enough money to buy 500 shares of stock. So when you buy on margin, you can purchase additional 500 shares. So magiging total shares mo na is 1,000. Madodoble yung profit mo. At dahil nga mataas yung return nito, expect din natin na mas mataas din yung risk niya. Kasi yung stocks mo sa margin, serve siya as a collateral for the loan. At kapag nag-decrease daw ng 65% yung stocks, you will receive a margin call from the brokerage firm. At after yung margin call, you need to give additional cash for the loan. And kapag hindi ka nakapagbigay, yung margin stock mo will be sold at ito yung ipambabayad sa loan. Another one is selling short. It is your ability to buy and sell securities. Dapat to dito magaling ka mag-predict kung ang stock price is mag-i-increase or mag-i-decrease. Usually kasi we buy stock and assume na mag-i-increase ang value nito. Ang tawag dito is buying long. But alam naman natin na minsan nagde-decrease ito for some reason. Kung napipredict mo daw na ang stock price is magde-decline, you can use selling short. When you say selling short, it is selling stock that has been borrowed from brokerage firm and kailangan mo din ipalitan in a specific period of time. There are 4 steps in selling short. First step is borrow of stock securities from brokerage firm. Second step is ibebenta mo ngayon yung borrow mo na stock kasi nga napipredict mo na magdi-decrease nga yung stock price. The step 3 is kapag tama yung prediction mo, bibilhin mo ulit ngayon yung stock in a lower price. In step 4, yung nabili mong stock ang ipapalit mo doon sa borrow mo na stock from brokerage firm. Trading option, it gives you the right to buy or sell stocks. Kung iniisip mo na mag-i-increase yung market price during specific period, you can purchase call option. When we say call option, ito yung nagkakaroon ng right ang stockholder to buy 100 shares with guaranteed price before a specified expiration date. Kapag nag-increase ang stock price, mabibili niya ito na mas mababang presyo and mabebenta for higher profit. You can also purchase put option. When we say put option, ito naman yung right to sell 100 shares of stock at guaranteed price.